Howdy who, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Hopefully you're all out enjoying the holiday season. Let's see what we got going on in the stock market. Well, we've got 8 straight up weeks. This will be the 9th week in a row if we can get another up week going. Now, this is a short week, a Ford trading day, half day on Friday, so a very short week. Easy to push the market around one direction or the other, but I think they can pull out a 9th straight week up. This is what's known as the Santa Claus Rally Week. This week and the beginning of next week is called the Santa Claus Rally officially, and they should be able to push it up higher for the 9th straight week. I think they want to get the S&P to the new record high. The old record was 48.18, and that happened 2 years ago in January, and now we're trying to get back up to that level, right? And I think they're going to do that. That should bring a lot of the retail investors into the market, and they will try to push it up even higher. But I think you got to be cautious here. You see, the market has had like a 16, 17% run on the S&P, but right now everybody's turned bullish. Everybody thinks the market's going to go up from here. Now, maybe it'll continue, but I think you should use extreme caution. I think they're getting ready for the rug pull. That's just my take. We'll see how that all plays out, but we'll just have to wait and see. All right, so let's get over to the real estate market. Now, as you know, these are the good times, right? These are the best of times. Stock market at a record high, housing market close to a record, drifting down in most areas, but close to a record high. These are the good times. We've had a good year, right? We didn't crash. No crash in the stock market, no crash in the real estate market. Okay, that's good. So I was listening to Glenn Kelman. Now, Glenn Kelman, he's the CEO of Redfin, so he should know some stuff. Now, he says we're going to go down next year. He says house prices will drop next year. He says by 1%. 1%, really? Okay, well, why not just call it flat? All right, and I hope we got another year of these good times. I don't think we do, but perhaps we do. Perhaps we're only going to drop 1% next year. Now, that's what he's saying. Now, let's say we only drop 1%. Let's say you go and buy a house now and you hold it a whole year and you change your mind. You want to get out. It's gone down 1%, so you've lost 1%. It's going to take you another 8% to get out, so you've basically going to lose about 9 or 10% of your money. Okay, now he says if you hold the house for 5 years or more, you're going to be fine. If you can just hold on to that house for 5 years, you should go out and buy right now, because 5 years from now, they will be much higher. Now, you see, this normally would be true, and normally I would agree with them, but there's some changes happening here. I don't think we're going to be higher 5 years from now. I think you may actually get another good year, right? You may be able to be flat for another year. But 5 years from now, no, I think you're going to be lower. Now, once again, I don't know anything. I'm just a realtor. I just have a computer and a microphone. But my take is we're going to be much lower 5 years from now, probably much lower 3 years from now. Now, why do I say that? Now, back in 2008, right, we had the subprime crisis, which led to the great financial crisis. In other words, real estate was the cause, right? Real estate brought down the banking system, and it even brought down Lehman Brothers, right? And that was a big bank to fail, and that was caused by the subprime mess in real estate. I know there were other factors, but a big chunk of the factor was that they packaged up all these subprime loans, sold them to Wall Street, and then people defaulted. They didn't make their payment. So these loans went bad and the banks went down. Lehman Brothers went down. Everybody went down because they were all leveraged. Well, I got news for you. They're more leveraged today. The banking system is a lot more leveraged. Now, they talk about too big to fail. It was too big to fail back then, and I'm sure there will be banks today that will be too big to fail. I don't think they're going to let J.P. Morgan fail. I don't think they'll let most of the big ones fail. Now, the little ones, I think the little ones are in trouble. I think Silicon Valley Bank was the canary in the coal mine, right? We had 5 major banks go out this year, right? And 2024, just getting started. We'll see how many drop in 2024. I think it's going to be closer to 100, maybe more. We'll see how that plays out. But I think the banks are still in a lot of trouble. So this is an important point to grasp, right? In 2008, real estate came crashing down, and that brought down the banking system. Real estate was the cause. Now, this time around, I think real estate is going to be the effect, right? Okay, it's not going to be the cause. The banks are going to collapse, and that's going to take down real estate. You see, real estate looks good, right? Everybody's locked into their forever home. They're handcuffed to the home. They can't sell it. They're locked in at 2.8%. No reason to sell it. They'd have to pay 7% if they want to go out and get a new loan. So they're locked in, right? Okay, so real estate probably will not be the cause. At least the housing market will not be the cause of the collapse. But there will be a housing market collapse because that will be the effect when the banking system goes down. Now, why do I say the banking system is going to go down when everything's great? Stock market record high, houses record high, economy is booming. I don't think the economy is booming, but you listen to Joe. He says it's booming. We'll take his word for it. Okay, we got a booming economy. Okay, so why do I think it's going to come down? Well, let's talk about this a little bit. You see, why did Silicon Valley Bank go down? Why did it go down? Well, you see what it did, it took your money, right? Went and bought bonds because bonds are a safe, secure bet. And they bought the long-term bonds, the 30-year bonds. And as rates went up, those bonds went way down. And then they kind of had a run on the bank. Everybody wanted their money. They didn't have the money anymore. So they went out of business. FDIC took them over and made everybody whole, spent a lot of money, depleted the FDIC money. Okay, now what's going to happen now in the banking system? Well, let's talk about this. Let's talk about the commercial side of the real estate, right? Okay, the commercial side of real estate is fascinating to me. You see, 50% of commercial loans, there's commercial mortgage-backed securities where they make a loan on a big office tower, right? They take that loan, they bundle it up, they sell it to Wall Street, let's say. Some of the banks hold these loans. A lot of the regional banks are holding a lot of commercial paper, commercial mortgage-backed securities. A lot of the regional banks hold this paper, right? Okay, so I'm just going to give you a rough example of how this is playing out right now. They don't talk about this on mainstream media. It would scare people. They don't want to scare you, but let's just talk about it. All right. So let's just talk about a typical building. A typical building would be, okay, this would be in Los Angeles. All right, the AON Center. AON Center. It's a skyscraper, right? 62 stories. I think it's the third tallest building in Los Angeles. Okay, so it's right on the skyline. There's 62 floors, over 1 million square feet, right? Okay, now in 2014, they bought this property for $269 million. $269 million. Now, that doesn't sound too outrageous. 62-floor skyscraper, right? Well, now this property's for sale, $137 million, 45% off, 45% off. Okay, right? Okay, and they can't get it. They can't get the money, so maybe it sells for even less than that. But my point is that these properties have dropped by 50%. They've dropped by 50%. This is commercial property, right? Big office building in Los Angeles. Another one. The EY Plaza. EY Plaza, that's only 41 stories high, right? Okay, 41 stories high. 1 million square feet of office space again. Okay, so 3 years ago, $446 million it was worth, right? So they went into the bank and they got a loan on the property. $275 million is what they own on the property. It was worth 446, so the bank said, sure, we're going to give you $275 million. Well, right now, that property is worth $210,000. It's for sale. You can buy. There's a lot of these in San Francisco also. This is the EY Plaza. EY Plaza. You can Google this if you want. The other one was the AON Center. You can Google that. The whole story's in there. But it was worth $446 million when they got a $275 million loan. But now it's worth $210 million. They still owe $275 million. And here's the kicker. There's a mezzanine loan on it for another $30 million, which brings the value up $305 million in loans, basically worth 205, right? So there's $100 million that somebody's going to take a hit on. Okay, now I'm not sure who holds the paper on it. It could be the regional bank, could be your pension fund. Your pension is not safe. Not safe right now. Pensions aren't safe. It could be an insurance company. Insurance companies can't pay their claims, so what do? They raise your insurance rates. Did anyone's auto rate go up? Did anyone's home insurance go up? Well, we know health insurance went up, right? Okay, all the insurance went up because they take the money and they invest it in office buildings like this. Well, they're taking $100 million hit just on this building. And this is owned by what's called Brookfield DTLA Fund. Okay, Brookfield DTLA Fund owns this office building, and the banks they're just handing it back, right? So the bank's going to lose $100 million on this. But this isn't the only property they're handing back. Now they got handing back 2 others in Los Angeles, another 2 across the country, 4 major skyscraping towers. They're just handing them back, and they're losing $100 million on each one. So these banks are not solvent. There is a solvency crisis, and the scale of this solvency crisis is just unbelievable. The banks, they're all insolvent, but Mike, look at the stock market. The bank stocks are up. Yes, they are, because they don't have to report it until they declare the loss, right? They don't want to take the properties back, but right now they're in the process of getting the keys to these skyscrapers back, and they're going to be marking them down. So these stocks are not going to be staying up at these levels. Could send the stock market down along with the banking system. Okay, all right. So there's a lot of banks that are insolvent right now. A lot of pension funds, they don't have the money to pay you. A lot of pension funds are insolvent. A lot of insurance companies are insolvent. A lot of corporations, 20% of the S&P 500 are insolvent. They're called zombie companies. The scale of the insolvency runs massive, right? Now, I know they're going to print trillions and trillions and trillions of dollars, and they're going to try to cover it all up. They're going to try to mask it, right? They're going to try to not let it happen. But eventually, this is a house of cards that's going to come tumbling down. And yes, it's going to affect your house of cards. The house that you own is going to come tumbling down. It's not going to be the cause this time. It's going to be the effect. You see, last time the housing market was the cause. Last time the housing market brought down the banking system, put Lehman Brothers out of business, and because the houses crashed first. This time the houses are going to crash after the insolvency crisis hits, after the debt bubble, the debt crisis hits, after the banks go under. A lot of banks are going to go under, but we have this huge insolvency problem. Now, Silicon Valley Bank, that was just a canary in the coal mine. But Mike, that was like a year ago. They've already solved that problem. But yes, we had 5 of them last year, and they papered over them. They're not allowed to talk about those on mainstream media. Now, leave me a comment if you think the banking system is fixed. If you think the crisis has been resolved, please leave me a comment there. I don't think it has. I think the banks are in big trouble. I think this is what has Jerome Powell scared. I think this is why he's penciled in 3 rate cuts for next year. Stock market's penciled in 6 rate cuts already for next year. This is going to come down, right? The stock market will come down, the banking system will come down, and this will be, your house will be the effect of what's going to happen in the rest of the financial system. Last time, back in 2008, the houses, that was the cause of what happened. It was the cause. This time around, it's going to be the effect, but it's going to be the same result. It's going to be your house going down. Now, I know you're locked in at 2.8%, and I know in your area nobody would ever sell their house below the price Billy Bob got out at. I get all that. You live in a great area, but a lot of people don't live in that area, and a lot of people are going to see their house lose 40, 50%, and that might be a conservative number to the downside in their equity. Not going to be the cause. It's going to to be the effect. This is just my take. I hope I'm wrong. I hope we have another year where we're just flatlining, right? Because this is the good times, really, right? I mean, hopefully you're out there enjoying these good times with your family and friends during this holiday season. But 2024 is going to be a turbulent year. We got an election coming. Maybe they can keep everything propped up. Maybe they can keep it all flat, but I don't think they can. I think the system is getting ready to come down. I think there's going to be some major changes, and I think it's going to bring your house down with it as an effect, not as a cause, because you're locked in. I get that, 2.8%. I get that. You got equity envy. You got rate envy. You got a lot of envy, but a lot of this envy is going to be going away soon. So enjoy it. Enjoy these good times, right? But if you're thinking about buying, you might want to hold off. You see Gary Kelman of, Redfin, he says if you can buy now and hold it for 5 years, you're going to be doing great. I say if you buy now, you wait 3 to 5 years, you're going to be in a world of hurt, but that's just my take. I'm Tall Mike. If you like this stuff, give me the thumbs up. Why not? Punch that subscribe button. Get out there. Enjoy the rest of this holiday season, and we'll talk again real soon. Bye-bye now.